Okay. Um. Okay. Good morning, everyone. Welcome to Phillip Securities Research Weekly Market Outlook. Today's agenda would be first the market outlook, followed by equities update by Derek, and finally Brian will feature a company Hobie. In terms of the market outlook, in the US, we are seeing signs of macro recovery gaining traction, right? In terms of labor market improvement in February, last Friday's data showed that unemployment rate actually came down 0.2 percentage point month-on-month to 7.7% in February, right? But in terms of granular data, labor participation rate actually declined quite a fair bit. So we're still cautious about the macro front in the US. Nonetheless, last week's data also showed a surge in core capex orders in January, and which means there could be more upsides for US investments in the months forward. But fiscal uncertainty still persists in the US, right? We have the danger of a partial government shutdown on 27 March, though that is partially alleviated with the US House actually approving a stopgap bill to extend routine government funding. Now what we wait for the Senate and the Congress to actually approve this stopgap bill. Last week also saw the China National People's Congress meeting, right? There are three main takeaways for that meeting. First is economic restructuring. Economic restructuring will be likely to be the focus going forth. So the focus will be more on quality growth rather than the quantity of growth. So in terms of target-wise, China is expected to grow around 7.5% this year, a shade lower than the 8% target set last year. The second takeaway is prudent monetary policy is expected to continue, with M2 growth for this year pegged at 13%, just a shade lower than the 14% target last year. The final takeaway is in terms of the broader real estate stabilization blueprint set out by the MPC, we expect property tightening to actually continue, right, to curb speculation, right, and avoid a real estate bubble. Right, so finally this week we will see the Italian Parliament actually opening on 15 March. At this juncture, Italy is still entangled in a political stalemate. There's still no signs of a coalition forming, and that actually casts doubt on Italians' reform commitment. And over the weekend, we saw Fitch actually downgrading Italy's sovereign rating by one notch to BBB+ with a negative outlook. This puts its rating in line with S&P, but just a shade more optimistic than Moody's, who has a rating on Italy at BBB. So moving on to the US, we saw the Dow hitting record highs last week, and the question in everyone's mind will be, will it be S&P's turn soon this week? Now, we're actually looking, or rather, it could be the case that S&P is looking for a green light from this week's US manufacturing as well as retail sales data. The retail sales data for the US this week will be of particular interest because we need to see whether there are signs of whether US consumers are actually delaying or cutting back their consumption in view of the payroll tax hikes at the turn of this year. So if retail sales turn out to be stronger than expected, then we will look to actually upgrade US from market weight to overweight. So currently our call now is market weight for the US but with upside potential. For the S&P, it faces strong technical resistance of around 1565 to 1575. In Japan, last week, the USD-JPY currency pair actually cleared strong resistance of the 95 level, right? Not cleared since August 09, right? Now, so it cleared it during Friday's intraday Asian session. Now it's trading around 96 levels, right? So a weak yen actually bodes well for the Nikkei. Right? The Nikkei has actually gapped up, and it also rose further this morning, right? So in the near term, there's upward bias for the Nikkei 225. But looking ahead, we caution that there could be markets could actually sell the FAC, and there could be also a possible disappointment on the 4th April maiden monetary policy meeting. That is when Kuroda will actually chair the meeting. So if it turns out that monetary policies implemented during the meeting turns out to be less aggressive than expected, we could see a pullback in the Nikkei. For the China A shares, it has been subdued for most of last week, and it actually needs to clear the 2728 resistance level to actually go higher. For the HSCI, it actually bounced up from its 10-day moving average, right, on account of stronger than expected exports data of Chinese exports data last Friday. Strong support at 11,000 levels and likely challenge 12,000 levels after the pullback. HSI has also bounced up from its 10-day moving average, right? But the question is whether are the bulls able to sustain above the 23,000 level, right? At this juncture, it's trading above 23,000, but it faces strong resistance at its 50-day moving average, which is the blue line over here. For the STI, we have been writing our morning commentaries that we expect the 3,300 level to actually be heavily defended, and indeed it turned out to be the case. It seemed that the bulls actually lacked high conviction to take the index higher above the 3,300 level. So till then, it could consolidate around this level, near-term support at 3,250, and if it clears 3,300, the next psychological resistance will be the 3,400 levels. The KLCI, notwithstanding in Malaysia, notwithstanding the ongoing mini airstrike in Sabah, we are seeing that the KLCI actually inched above its 50-day resistance level, right? But nonetheless, we actually caution that political risk still lingers ahead of the upcoming 13th general elections. For the Thai index, it broke out of a tight consolidation range last week, right? It's still showing strong resilient uptrend, and there could be near-term upside for the Thai index because over the weekend again, Fitch upgraded Thailand sovereign credit rating by 1 notch to BBB+, but it's just merely in line with S&P's and Moody's ratings. With that in mind, I'll pass on to Derek, who covers research updates for the week.
Hi, good morning everyone. Thank you for joining us today. Some research updates for the week. We started off last week with an update on the global macro asset strategy. Subsequently, we issued a report on Tiger Airways after they announced fundraising needs. This is actually, we actually highlighted this risk to investors earlier on, as we find that the leverage of Tiger Airways was fairly high at the moment, previously. And with this fundraising exercise to raise $297 million, the funds raised will actually show up the balance sheet strength and allow provide capital for expansions across the region. Commodity sector, we provided an update on that as well. We find that there's a very high level of CPO inventory in Malaysia, which could weigh down on the prices in the near term. However, if you look at the CPO discount to soybean prices, it is abnormally large, and that could see a demand shift to CPO. Just by way of background, soybean oil and CPO are actually substitutes, and historically, the price trend between them has been fairly could actually normalize over a long period of time. The US Congress also revived the tax credit scheme that could actually make importing CPO as biodiesel commercially viable. On the angle, we actually prefer Golden Airy over Wilmar for its pure play exposure to the CPO upstream market. We provided an update on the banking sector as well. We expect NIM's pressure to continue going forward in the near term, and management across the sector actually guides for high single-digit loans growth in 2013, with fees and commissions as a key revenue driver. Among the three banks, we actually prefer UOB over DBS and OCBC. The last update that came in at the end of the week is Singapore Equity Strategy Report, where we actually highlighted our views on the various sectors. Among the different sectors, we actually prefer industrials, capital goods sector, which is quite a blended sector with a lot of companies inside, which has a very unique individual characteristics within each. But either way, the whole sector is expected to perform well in the year ahead. Commodity sector, as mentioned earlier on, is actually the wild card with potential for upside in the CPO prices after inventories are worked through. As recent telcos are no longer cheap on valuation terms, and property sector is unlikely to do as well as with the impending price correction in the property market and office rental rates. We continue to observe margin pressures on the banks and transport sector, and that could weigh down on sentiments in the sector. Our top picks for the Singapore market, we actually replaced CapitaLand with Boston Singapore. And now our top pick list is SI Engineering, Pan United, and Boston Singapore. I highly encourage our clients to take a read through this report, where we can provide a consolidated view on individual stocks as well as the various sectors. So a summary, these are the stocks that we actually prefer in the various sector. Golden Agri for the commodities and supply chain managers. Banking and finance, we prefer UOB. For developers in the property space, we prefer CapitaLand and Hobie, which is the company that will feature later on today. For the REIT sector, we prefer Parkway Life REIT. Industrial capital goods sector, we like SI Engineering, Pan United, and Baostit Singapore, three of which are our top picks in the Singapore market. In the transportation sector, Singapore Airlines is rated as accumulate, and we think that the stock is far too cheap at the current price. Telco side, we prefer Singtel over M1 and StarHub. These are some relative valuation metrics that is attached for your reference. For the latest recommendations on our stocks, clients could refer to our daily morning note for our recommendations. With that, I'll hand over to Brian, who will talk about Hobie.
Hi, good morning. This is Brian here. Today I'm going to talk about Hobie. I believe most of you would have been very familiar with Hobie. They have been around for many years in the property segment. Just a brief overview. They have two main business divisions, mainly the property development, where they involve in the mid to high-end residential development, and they have made their dominance in the Sentosa Cove, where they have secured most of the land on Sentosa Cove. And second one is property investment, where they build and keep some of this property as their investment assets, such as high-tech or light industrial building. And they also previously they have hotel, one hotel, Windsor Hotel, but they have divested as of end of last year. So you can see revenue contribution mostly from property development, and the property investment segment has been shrinking as they has in the past 2 years they have been selling their investment properties to redeploy the capital into the development of a Grade A office building. So these are some of the track record. They have built mostly the high-end residential, like the Orange Grove at Orchard area, and also these are some of the example of the light industrial and high-tech industrial building. And this one is One Pemimpin, which they strata titled it and sold it last year. And for Hobie, we look at the property development segment. As you would know, the past 2 years is a challenging period for the high-end residential property developer, where the government implemented rounds of cooling measures, and most of the time they are targeted at the high end. So for Hobie, their project mainly located at this one at Orchard, this one Holland, and these two here it's Sentosa Cove. So most of this project in this table are already completed. So you will be noticed that the remaining inventory would be so-called a center at the Sentosa Cove, where they have more than half of the project is unsold. And what they do with this unsold inventory is they have been leasing out these units and collect rental. So at the moment, the rental income is more than enough to cover whatever financing expenses and tax expenses that needs to pay. And meanwhile, they still continue to market these projects to potential buyer. And the potential for this inventory is that the stock at the Sentosa Cove is limited. So the government is already not selling any more land on the island itself. So these are limited stock, I would say, and they have the holding power to continue holding this inventory. And the saving grace is that this land or this inventory are not subject to the so-called extension fee penalty that is imposed to the other land, because this land that they holding are actually they got it from government land sales tender, which is excluded from those extension fee concern. So they can holding on to this inventory at the moment and continue to market it to the potential buyer. And in their land bank, we have Hobie has this Pinnacle Collection, another land on the Sentosa Cove itself. It's a JV, so they have 35% stakes, and this is currently construction is undergoing, and it should be completing in this or next year. So this one they have no concrete marketing plan yet because of the challenging environment. And the rest, these three lands here mainly located in China. This one in Shanghai, this one in Tangshan, Nanhu, and this one is Zhuhai. So most of the China project are JV project, so they holding minority interest of 20 to 40%. And another two pieces of land is located at Australia. And these are still early in the planning stage, so they have no concrete development plan yet. So we have not put in any figures for this project. So as you can see, the operating environment is quite challenging for Hobie. So today the story that I'm going to tell is not about a growth story, but it's actually a value stock. And how we think that this stock is cheap is because of their investment property operation. They have the Metropolis, which is this development will be completing by end of this year, and it will provide about 1 million net lettable area of Grade A office at One North. And optimistic story is that they have been 60% pre-committed by big corporation as of their last result announcement. So we were pretty encouraging by the progress. And just a simple back of envelope estimates. Their total development cost is about 1 billion. And valuation, it's about 1.45 billion. And our valuation of 1,350 per square foot is based on in between the comparables that we can see here. NOL building, it's sold last year, and it sold at 1,831 PSF. But this is a freehold building and with asset enhancement potential, so it's slightly higher. But the comparable one would be PSA building. And also the Bank of America Merrill Lynch, which is under the Maple Tree Commercial Trust. So this one, it's located next to Vivo and it's closer to the CBD, so it's slightly expensive, 1,450. And that's how we derive our valuation for a Grade A office at 1 North. It's we currently price it at about 1,350. And with the surplus of 386 million, this potential reval gain would be recognized upon completion of this building by end of this year, and that translates to about slightly higher, slightly over 50 cents in per share basis. So with that, we look at the 2013 earnings for Hobby. We were pretty worried about their earnings for this year previously because most of their residential project already completed in 2012. As you can see, even in a challenging environment, they still managed to remain profitable. Is because they still have the progressive recognition from their residential sales over the past 2 years. But for 2013 onwards, they don't have any more significant progressive recognition. What they remains here, our forecast of 109 million is mainly from half of it is from this divestment gain, where they will be recognizing in 2013. 26 million is from the divestment of Windsor Hotel, and also 32.7 million from selling this property investment holding in China. So from here they will be taking in 58 million net gain from this divestment. And the remaining 50 million in our projection would be from some balance percentage from their completed project, such as the Trilight and the Parvis. So, and also we have forecast a pretty minimal sales forecast for their Tangshan project, which we think they will launch this year. So this 109 million will make up their bottom line. And in terms of reval potential, the 380 million, we also price it in here. So that makes the forecasted PATMI to slightly over 400 million for 2013. And in terms of Metropolis, they will be providing recurring income of 50 million per year if based on a stabilized basis. So from 2014 onwards, this is the potential support for their bottom line. And current valuation, it's inexpensive in our view. When we look at their net gearing, it's very low. They know that their profit, their revenue going to shrink, so they have been very prudent in their leverage. It's 0.17 times net gearing, and more than enough to cover their future development expenditure. And FY12 book value, that's $2.58, which compared to the current trading price $1.86 is about 28% discount. And we have a RNAV of $3.82 on the stock. And the company still continue to buy back their own shares in the current share price, or even at $1.90. And currently, outstanding shares, 73% of them, that's on the hand, is held by the chairman, and also including the 73% is about 2% of the treasury shares. So they still keep accumulating through the share buybacks. And if you buy before May this year, you will get the dividend of 5 cents, which proposed by the management in the last quarter results. So our target price of $2.29, it's priced at 40% discount to RNAV. And on a forward basis, we look at 2013 book value, it could reach $3.14. So that means you are buying a stock today at $1.86 for the value of $3 stock in by end of this year. So we think that the current valuation is still undemanding. So with that, I end today's presentation, and we welcome any question that you have. You may send it in, and we will try to address your question. Thanks. Okay, there's a question for Hobie on the seascapes, where in the fourth Q, there's this -3 units sold. We may refer to the slides. Okay, the -3 units is this is a estimate that we derive from the percentage that is given by the management. So 3%, it could be due to some return units by the previous owner, and this is not very uncommon. In the previous quarters, we have seen 1 or 2 units, quite low percentage that sometimes the owner may be may not get the financing or whatever, so the sales may not go through. That's why they have these negative figures. And in terms of another question on, do I have holding on Hobie? No, obviously I don't have, because our policy is we are not allowed to hold the company that we are covering. And I will pass on to my colleague for other questions. Thanks.
Hello, Joshua here, Head of Research. Okay, we have a question on Bousted. Simple question of, are we covering Bousted? Yes, we are. So we initiated on Bousted, I think, about 2 weeks back, and the target price is 180. We initiated at a price of 127, so today is $1.36.5. So it's appreciated about 7% since then. We're also thinking that this year they will raise the dividend to about 7 cents, if I recall correctly. Yeah, we're bullish on Bousted. We like the company a lot. It's got a very strong economic moat in its geospatial division, which is, and what geospatial is, it's software mapping, but you can populate all the objects on the map with data, qualitative data and quantitative data, and you can analyze it. So this software is extensively used by 60% of the governments worldwide. It's the gold standard, and Bousted is exclusively marketing this software in Australia, Singapore, Malaysia, and Indonesia. And it's got very steady returns of about 12% a year, and very strong margins, about 25% profit before tax. Apart from the geospatial, they're also a market leader in industrial property design and build. They are one of 3 full turnkey back-to-back end-to-end developers. And so on those 2 things, well, we think that earnings are going to hit a new level this year, about 13 over cents a year. And because of that, dividends will probably be raised to about 7 cents, because they have a consistent record of paying out dividends. And so right now at the price, we think that that's serious potential for it to re-rate, and it has actually already been on a re-rating trend. So $1.80 is our target price. Okay, I'll pass you on to another colleague for other questions.
Hello, good morning. I'm Travis. I cover the REIT sectors. There's a question on S-REIT. May I ask the reasons and basis of the comment on S-REIT are not cheap now in the presentations? I think as we have seen that S-REIT has performed exceptionally well last year, gaining about 41% in terms of total return. So I think that this year's it's not likely that the S-chip will be able to outperform the STI index, despite that they have done so year to date. The reason why we think that S-chip are not cheap because of the high valuations, as they have reached valuations, as we have seen over the past one year. And the DPU growth is limited for most of the sectors, other than the industrial sectors, where we do see rental reversions of 10 to 20%. And now, because of the high prices in S-REIT, they are taking this, the REIT managers are taking this opportunity to doing private placements and right issuance to shore up their capital structures. And because of that, this will may allow a good entry price for investors as well.
Hi, it's Brian again. I have a few more questions on Hobby. Questions on whether Hobby is takeover target or privatization target. Takeover, I think it's less likely. And in terms of privatization, I don't rule out this potential because free float is pretty low, and the chairman and the company is already holding more than 70%. So if they want to privatize this, it's not a difficult problem it's not a difficult task in my opinion. And looking at the so-called the need to tap the capital market is also quite low because they have low gearing, and those they have after the metropolis they have no more significant project in the market in Singapore. So I don't rule out the potential of privatization, given that it's significantly discount to the book and the potential value. But again, there's no certainty in any speculation on this kind of privatization. So the above is just my comment, and we also have no certain clue on whether they want to privatize or not. But if they want to do so, I think it's not a difficult task. That's what I can comment. And I'll pass on to my colleague.
Alright, I'd like to tackle 3 questions. The first question being that of Greece finance minister holding new talks on Sunday with the country's international creditors. I guess like what we indicated in our global strategy report is that in the Eurozone, Greece is definitely not out of the woods yet, right? Because if you look at how Greece has actually evolved, Greece is actually being held to a very, very tight fiscal targets by the Troika. The Troika will comprise of your IMF, your ECB, and the European Commission, right? So the question is that whether Greece can actually meet these fiscal targets. The question is whether, so the question that Daryl posed would actually be whether would there be any negative impact on the global market. My personal sense is no, because we all know that Greece is not out of the woods, right? And the question really the markets would be looking at is whether Greece can actually meet its fiscal targets that are set by the IMF, ECB, and European Commission, right? So, and at this juncture is still early days, right, to judge whether can Greece meet its reform commitments, but there's a high risk, I would say more than 50%, that Greece is unable to actually meet its reform commitments but there's a strong political commitment to actually hold Greece to keep Greece within the Eurozone. So in terms of negative impact on the global market of this particular event, I think the near term is relatively likely to be muted. On the second question of the outlook for gold and crude oil, I guess for the outlook for gold, we have actually been underweight gold since fourth quarter of last year, and at this juncture, gold, the reason why we underweight gold is on account of two factors. The first factor is that a risk-on sentiment, right, is typically negative for gold, right? So the risk-on sentiment is what we are seeing right now, and it's typically negative for gold. Secondly, a stronger US dollar, which is what we are seeing in recent days, is also a negative for gold. So on both accounts, gold is likely to, there's a downward bias for gold, at least in the near term. In terms of crude oil, I guess as of last Friday, the bullish labor market data, where we saw unemployment actually reaching to around a 4-year low of 7.7%, actually bodes well for crude oil. So there are actually some signs of crude oil bottoming out, but I think in terms of keeping pace with the broader equity rally, I think crude oil or in general commodities are actually still lagging behind. So that's our answer for these two questions, and if there are any more questions, we're happy to take them.
Hi, quite a lot of you are asking for the slides. So if you're a remiser, you should be receiving the slides after the presentation, because we will email them out to all internal dealers. Okay, and so I think in your mailbox you should receive the slides. Now, if you're a client and you want the slides, then you'll have to approach your remiser, and they can forward the slides on to you. Okay, there's another question on Hobie. Okay, there are no more questions coming, so thank you all for attending. As usual, we enjoy sharing with you our views, and please keep the feedbacks coming as well. Thank you. All right, tune in next week. Bye.